Hi guys, and welcome back to another episode of accounting. Today's video is the fourth in the series that I'm creating on accounting basics. I have been getting lots of positive comments from you guys so far, so thank you. I really appreciate it, and I'm glad this videos could help you out. If you missed out on any there, I'll link to them in the description below. I'm going to start putting this video up on weekly basis. So if you haven't already, hit that a big subscribe button so you don't miss out the next one. So what are journal entries? Let's find out in the previous videos. I showed I show you that the T account is a usual representation of accounts and how to record transactions using them. However, in day-to-day life, T accounts aren't that practical to use. They take up lots of space and it's easy to miss a sight of transaction. We need another more efficient method for recording our transactions. But why is it important to record our transaction? First, you can use financial report to measure performance of your business, to see if you are doing well or badly. It enables to you manage your cash flow so that you don't run out of it. Third, it's helpful to keep things organized, as also useful at the tax time to avoid missing out the any deduction. And finally, if your business were to get audited, it's handy to have that paperwork ready. In fact, the process of recording financial transaction is so important that we have a word for it: bookkeeping. Bookkeeping can be done on any budget, no matter how big your business is. Here are a few examples of some different accounting software that you can use different budget. I will throw the link to few this in a description below. Now that we know why bookkeeping is important, we need a method to record transaction. Earlier I said that T accounts are important, so we can have to try out something else: journal entries. So what are journal entries? When abbreviated is record of financial transaction, and it looks like this. First, we have the journal number. This is a unique reference number that is used to identify the journal. Then there is the journal entry date. This is the date that the journal is posted in the journal ledger. It's important because it affects the accounting period that the transaction is going to show up in. Next, we have the name of accounts that are impacted by journal. In this case, cash and owner equity. Notice that owner equity is indented. We indent the name of account that is getting credited, so that is easier to see. Then we have separate column for all the debit and credit entries. And finally, there is a journal description below. It's good practice to give a solid explanation here, since you may need to refer back to journal in the future. And good description will make it much easier to remind yourself why you enter it in the first place. Remember, we are talking double entry bookkeeping, so there must be at least two sides of the journal, and the total of those debit and credit column must be the totals of those debit and credit columns must be match each other exactly, because the accounting equation always balance. If you are using accounting software like QuickBooks or of any of those other that I mentioned you previously, you won't let you post the journal unless the debit and credit match each other exactly. Since this is key control, however, if you are using sheet or Excel, then you are on your own. And watch out this: there are two types of journal: automatic journal